Hi, I'm Robetul binti Abdul Rahim.
Hi, I'm Nur Eva Natasha binti Buang.
And I'm Ismahani Daini binti Ismuni.
So today we want to present about corporate finance decision making on capital structure.
The term capital structure describes multiple of methods by which a company finances its asset. According to Bahduri, a company can choose from several kinds of debt, equity, and other financial structures. The establishment of Modigliani and Miller's, or we know as M&M, theoretical model of corporate capital structure in 1958 has recognized as an important turning point for new corporate finance theory. The procedures for figuring out the best capital structure are determining the capital structure's elements and evaluating company risk by determining the equity, also the debt, such as bonds, loans, or other borrowed funds. Furthermore, the riskier a firm is, the more equity funding it needs. So the business must evaluate its position and any risk by looking at economic considerations, market position, industry, and revenue stability. To conclude, figuring out the best capital structure for a business trying to maximize shareholder value has been a difficult and elusive goal. The mix of debt and equity under circumstances will optimize the overall value of the company and is known as the optimal capital structure. However, the present value of all anticipated future cash flows to be produced by the assets was discounted at the company's weighted average cost of capital, which is known as WACC. Based on assumptions related to the capital market, Modigliani and Miller illustrate that firm value is unaffected by the capital structure of the firm. This is because there are no taxes, bankruptcy costs, agency costs, also asymmetric information. Apart from that, the theory provides insight into a company's choice of capital structure in a capital market without transactions fees, taxes, and other barriers. According to Ziotler, Henking, and Sedner, 2007, debt is an essential aspect of a company's capital structure and serves as an intermediary for corporate finance since corporations take out loans to raise the funds they require to fund capital expenditures. Finally, according to Silbikov, 2009, states that equity allows the company to get money without relying on debt. This implies that there is no deadline for repaying the money acquired through equity. Thus, the authority that receives dividends or future capital gains from the company's profit is granted to the shareholders, so companies should consider a combination of these distinct financing options when analyzing the features of debt and equity.
Next, I will discuss about the factor effect capital structure and capital decision. The capital structure of a company refers to the mix of debt and equity financing it uses to fund its operation and growth. There are several factors that affect the capital structure and capital structure decisions. The first factor that affects the capital structure and capital structure decision is, first, business size. The business size plays a crucial role in determining the capital structure due to differences in access to resources, risk tolerance, and financial strategies. Small-scale businesses will face some difficulty in getting loans for their own business operations. They will also rely on a high equity methods and very high interest rates from the lenders they borrow from. In addition, they will face a high risk and limited business perceptions due to their over-reliance on borrowing methods. Second, business risk. Business risk refers to the uncertainty and variability in a company's earning before interest and taxes, that is EBIT, due to factors like market competition, operational efficiency, and industry conditions. Companies with higher business risk face greater uncertainty in their earnings, which can make it difficult to meet debt obligation. But as a result, such companies choose to practice equity to maintain their businesses, flexibility, and avoid the potential for bankruptcy compared to low-risk businesses that practice. Third, growth rate. Growth rate plays an important role in capital structure decision making. It has been observed that faster growing firms mostly rely on external capital as the flotation cost exceeds. It is also possible that the firm relying on external capital may often face greater uncertainty, due to which they may reduce their willingness to use debt. Fourth, market conditions. Market conditions that affect a company's capital structure. Market conditions refers to overall economic, financial, and industry-specific environment in which the company operates. For example, rising and falling inflation rates, investor sentiment, interest rates, and access to capital markets directly affect a firm's choice between debt and equity. Lastly, management style. Different management attitudes may bring different changes in capital structure decisions. Management may be conservative or aggressive depending upon the attitude towards risk-taking. Both managerial style exercise according to their own judgments and analytical approaches about the proper capital structure. If the management attitude is conservative, it uses less debt, where if the management is having aggressive approach, then it uses more debt to get higher profits. Move to the next point. I will discuss about the financial distress. Financial distress occurs when a company struggles to meet the financial obligations, such as paying interest, debt principal, employee wages, or supplier invoices. This situation can result in reduced operational efficiency, diminish the investor confidence, and, if unresolved, it leads to bankruptcy or liquidation. Companies in financial distress often face a higher borrowing cost, reputational damage, and limited access to credit. Numerous factors contribute to financial distress, include both internal and external influences. Key debt financial factors include first, leverage. Leverage refers to the use of borrowed funds to finance a company's operations or investments. While leverage can amplify returns during favorable conditions, it also increases a firm's risk. A highly leveraged firm is more vulnerable to financial distress, especially when cash flow declines or operating conditions deteriorate. If borrowed funds are mismanaged, the inability to meet debt obligations can result in severe financial strain. Second, profitability. Low profitability is a significant factor that can lead to financial distress. Companies with minimal profits often experience reduced liquidity, which hampers their ability to meet obligations. Persistent low profitability erodes financial stability and increases the likelihood of financial hardship. Third, the revenue growth. Revenue growth is a key indicator of a company's financial health. A decline in revenue growth serves as an early warning sign of potential financial distress. Companies with stagnant or declining revenues often struggle to repay creditors and fulfill financial commitment and investment in profitable ventures. And lastly, the firm size. The size of a firm, measured by its total assets, also influences its vulnerability to financial distress. Smaller firms are more susceptible to financial challenges due to limited resources and expertise in managing finances. Negative cash flow shock can severely impact smaller firms which often lack the capacity to employ experienced professionals or access sufficient financial and non-financial resources. Consequently, smaller firms face a higher likelihood of financial distress, particularly when they encounter difficulties in repaying borrowed funds with interest. Other than that, financial distress in firms can also arise due to non-financial factors, which encompass customer-related issues, management experience challenges, sales difficulties, and external disasters. These factors, along with macroeconomic influences like inflation, exchange rates, volatility, interest rates, and political unrest, can significantly impact a firm's operational and financial stability. First, inflation. High inflation rates creates uncertainty in the business environment, discouraging investment and raising production costs. Firms exporting goods may lose competitiveness in the global market due to inflationary pressures, leading to reduced profitability. Persistent declines in profitability increase the risk of financial distress. Second, exchange rate volatility. Fluctuations in exchange rates can adversely affect firms that rely on imported raw material or technology. Currency depreciation increases import costs, raising production expenses. When firms struggle to break even due to high costs, they experience liquidity challenges, losses, and difficulty meeting the financial obligations. Third, interest rate. High interest rates discourage borrowing and make it difficult for distressed firms to recover. Elevated borrowing costs reduce profit margins and discourage investment, while firms unable to meet principal and interest payments face an increased likelihood of financial distress. And lastly, political unrest and policy instability. Political unrest and policy instability can disrupt firm operations, threatening their survival. Frequent changes in government policies can adversely affect sales, supply chains, distribution networks, and expansion plans. Uncertainty in the political landscape undermines decision-making and damages a firm's reputation in the global market, exposing it to financial instability. Next, I will move to the next part. That is, I will explain more about the integration tax effect and capital structure. The integration of tax effects and capital is a cornerstone of modern financial theory and corporate decision-making. It involves examining how taxes influence the cost of capital, corporation valuations, and investment strategies. This integration ensures that firms can optimize their financial structures to maximize the value for shareholder while navigating the complexities of taxation system. By understanding the relationship between taxes and capital, firms can make informed decisions that improve financial efficiency and strategic positioning. First, you need to know about the cost of debt and the tax shield. One of the most significant ways taxes impact the capital is through the cost of debt. Interest on debt is the typically tax deductible in most jurisdictions, creating what is known as the interest tax shield. This tax shield reduces the effective cost of debt, making it an attractive source of financing for many companies. Second, weighted average cost of capital, known as WACC. Taxes also influence the weighted average cost of capital WACC a critical metric for evaluating investment decision. WACC represents the average rates of return a company is expected to pay its capital providers, weighted by the proportions of debt and equity in the capital structure. Because the cost of debt is reduced by the tax shield, WACC tends to decrease with the inclusion of debt financing, up to a point where financial distress costs outweigh the benefits. Lastly, tax effect on equity returns. Equity financing, while not directly benefiting from a tax shield, is affected by tax policies related to dividends and capital gains. In jurisdiction where dividend income is taxed at higher rate than capital gain, shareholders may prefer companies that reinvest earnings or execute share buybacks. This preference influences the cost of equities, as firms must offer higher return to compensate for unfavorable tax treatment. And lastly, you need to know about the capital structure optimizations. These firms often seek to optimize their capital structure by balancing the tax benefits of debt with the potential risks of financial distress. It quantified the value of tax shield, concluding that they represent a significant but not unlimited benefits. Excessive reliance on debt can lead to increased bankruptcy risk and agency costs, which offsets the advantage of the tax shield. As a result, firms strive to maintain a balanced mix of debt and equity that maximize their overall value.
Agent cost of equity. We define an agent relationship as a contract under which one or more persons engage another person to perform some service on their behalf, which involve delegating some decision-making authority to the agent. If both parties to the relationship are utility maximizers, there is good reason to believe that the agent will not always act in the best interest of the principal. The principal can limit divergence from his interest by establishing appropriate incentive for the agent and by incurring monitoring costs designed to limit the aberrant activities of the agent. In addition, in some situations, it will pay the agent to expend resources to guarantee that he will not take certain action which would harm the principal, or to ensure that the principal will be compensated if does take such action. However, it is generally impossible for the principal or the agent at zero cost to ensure that the agent will make optimal decision from the principal's viewpoint. In most agency relationships, the principal and the agent will incur positive monitoring and bonding costs, and in addition, there will be some divergence between the agent's decisions and those decisions which would maximize the welfare of the principal. The dollar equivalent of the reduction in welfare experienced by the principal due to this divergence is also a cost of the agency relationship, and we refer to this latter cost as the residual loss. Next is pecking order theory. The pecking order theory of capital structure is among the most influential theories of the corporate leverage. Originally developed by Myers Majlouf, 1984, it considers the role of information asymmetries, held assets and investment between firm and capital markets. According to Myers Majlouf, to minimize the cost of borrowing, the source of capital with the lowest degree of information asymmetry should be preferred. When outside funds are necessary, firms prefer debt to equity because of lower information costs associated with debt issues, while equity is rarely issued. Later, These ideas were refined into testable prediction and confirmed by Vogt 1994, who finds that internal funds have an important influence in firms' investment decision. Pecking order behavior is most pronounced in firms that have low long-run dividend payout policies. Generally, this procedure implies that internal funds are favored against external funds, and for the latter, debt financing is favored against equity financing. As the pecking order theory, there is no optimal target capital structures. Signaling hypothesis. Signaling hypothesis suggests that given the information asymmetry between inside managers and outside shareholders, costly dividends can be used to signal the firm's future prospect and thus can be used to solve the adverse selection problem. However, it is also a method that facilitates communication between the company's internal stakeholders, usually represented by financial managers, and external stakeholders such as investors, capital investors, or the general public. Its purpose is to convey information about the company's financial status. The intended signal is related to information about the company's internal management strategy that aims to meet the wishes of capital owners. This information serves a crucial determinant for investors when making investment decisions regarding a company. This theory adequately addresses the requirement of the company's internal stakeholders with regard to the company's prospects, taking into account that the company's management has greater influence over the circumstances and forecasts of prices and businesses' operation in the future. Managers can utilize financial reports as a means to communicate this signal, which outline the efficiency of implementing company strategies. This enables investors to gauge the extent to which the company can meet its future objectives. The information derived from signaling theory can have both positive and negative implications. A positive signal signifies that the company is experiencing a rise in profits, whereas an adverse signal indicates a decline in profits for the company. On the other hand, signaling hypothesis distribution of dividends allows the managers to signal to the market the true types of their company indeed, starting from the idea that there is an information asymmetry between the initiates or the best informed, the insiders, and the uninitiates or the badly informed, the outsiders, is such that investors can evaluate the firm from the distribution of returns that they perceive from signal transmitted to the market. For example, if a company like Coca-Cola announces an increase in its dividend payout, investors may interpret this as a sign that the company is performing well and has stable, predictable earnings. This can lead to an increase in the company's stock price, and investors view the higher dividend as a signal of financial strength.